Alan Sinai is the president and CEO of Decision Economics. He's also the former managing director of Lehman Brothers Global Economics. He joins us now from Boston. Dr. Sinai, welcome back to Bottom Line. Always a pleasure to have you on.
Well, thanks. Good to be with you.
Sir, is the concern about the debt ceiling warranted? Chairman Bernanke, with whom you meet from time to time, says there would be dire consequences if that ceiling isn't raised. But Tennessee Senator Bob Corker told CNBC today, quoting here, "We have a lot of things we know will keep us from ever defaulting on our debt." Is he right?
Well, you want to separate out the debt ceiling issue from default. I don't think we're going to default. I think Congress will find a way to avoid a default. Both sides are working toward that. They just won't do the fiscal responsibility side of the budget deficit problem that everybody would like to see and that would satisfy everyone.
And what is that fiscal responsibility side, sir?
Oh, it would be, well, the fiscal responsibility would be a much bigger program, be more the $4 trillion program of deficit reduction over 10 years that involved both good-sized expenditure reductions and also some increases in tax revenues, not necessarily tax rates, but tax revenues. But they're not going to agree on that. They're going to agree on a smaller package. The Reid package you just talked about has elements in common with the Republicans, and the Republican package is very small and has a political problem for the president because he wants an extension through 2012. At the end of the day, they will not allow us not to pay our bills to creditors on the Treasury side. We will not default. I think, though, we will suffer a downgrade, and that will have market impacts.
And what might those impacts be? We were seeing a little bit of rattling of global markets today because as of this weekend, there was concern that maybe something should be done before the Asian markets open, and that did not happen.
No, because I think the markets understand that we will not default. That is unthinkable. And there are a lot of ways to avoid it, as Senator Corker said. If we had no agreement, which is the worst case, that had both sides agreeing to some sort of a debt ceiling increase, whether it's $1 trillion or $2.4 trillion in some time frame, if we didn't have that, the government would pay the interest on its debt and pay the maturing proceeds, and then would have to cut back on other outlays to other segments of our society. That would be a terrible thing, but it wouldn't cause a default. In that situation, and I think even if we do get a deal of what we're seeing now, the rating agencies would surely downgrade us, and I think they're going to downgrade us anyway, because if you look at our process and our fiscal future and a deal which is not a big picture deal that doesn't solve our deficit and debt problems, the rating agencies have downgraded other countries. They will downgrade us, too.
Dr. Sinai, when that downgrade, if that downgrade does happen, what's going to be the reaction here in the U.S. and what's going to be the reaction in global markets? We just had Ben Willis of Sunrise Securities speaking to our Zara Burton at the exchange, and he said that a credit downgrade isn't necessarily a death knell for equities.
No, it's not. I think the place you see trouble first is where we have been seeing it for some time, in the dollar, in the erosion of the dollar, except against the euro and the yen, against almost all other currencies of the world. The dollar is no longer a safe haven currency. It's clear in the currency markets. Global investors move away from the dollar. That's the first place. And we already have been seeing that for a long time. That's the edge of the financial crisis. Equities earnings, the S&P 500 earnings have been absolutely sensational. And the stock market's all about earnings and interest rates. And so not until this whole picture makes everyone scared about future earnings would we get a huge hit on the equity market. And as far as longer-term treasuries go, that's really what should give way. We should see higher long-term rates on a downgrade. There's always, on any downgrade for any country, there's a momentary bit of panic and concern. The first time it happens, it goes away. It isn't too bad. Crises come in ebbs and flows. This is an ongoing financial crisis for us and how we handle our fiscal affairs and how we finance our government.
Dr. Sinai, in our last minute, should the debt ceiling be done away with? Until this year's name-calling and finger-pointing, raising the debt ceiling, it was a fairly routine exercise.
You know, that's right. We're one of the only countries that does that. The problem is there any other way to get fiscal responsibility in Washington except to have a fight over something like a debt ceiling and get everybody to the table negotiating. So they are negotiating at the table. We are going to get some expenditure reduction, not enough. We are now focused as a nation on this mess of our fiscal situation, and I don't know how else we would have gotten here except for this nitty-gritty debt ceiling kind of thing. It's a sad statement on the fiscal irresponsibility of the United States of America. And you know what?
Yep.
This will not go away for a long time.
Right.
We have lost credibility probably for years as a result of this process and what we're all living through at this moment.
Dr. Alan Sinai, President and CEO of Decision Economics, joining us from Boston. Dr. Sinai, it's always a pleasure. Thanks so much.